All right, let's talk about Mueller Water Products, ticker MWA. Now, this is a fascinating one. They just came out with what on the surface looks like an absolutely killer quarter. I mean, they blew past expectations. But the stock went the other way. So what in the world is going on here? Let's dig in and figure it out. Here's how we're going to break it all down. First, we'll look at that strange disconnect, the beat and the drop. Then we'll dive into just how good this quarter really was. After that, we'll get to the guidance, which is really where things get interesting. We'll put management stories side by side with the markets, and then we'll wrap it all up with our final take, the next call. Okay, so first up, the beat and the drop. This is the real head-scratcher, right? A company puts up great numbers and the stock falls? It just doesn't seem to add up. But when you look closer, the numbers start to tell a pretty interesting story. So first things first, let's talk profit. On an adjusted basis, Mueller delivered 38 cents per share. Now, you got to remember, Wall Street was only looking for about 34 cents. That's a solid 12% beat. I mean, in any book, that's a really strong number. And hey, it wasn't just a bottom line story. They beat on revenue too. Net sales hit over $380 million. That's about 5% more than the consensus estimate. So let's be clear, a beat on the top line and a beat on the bottom line. Looks great, right? You'd think the stock would pop on news like that, wouldn't you? Well, it didn't. In fact, the day after they reported, the stock fell 4.4%, and not just on a little bit of trading. We're talking heavy volume. So what gives? This is the core question we need to answer. So to really get to the bottom of this, we have to pull back the curtain and see just how fantastic this quarter and really the whole year was for Mueller. We're not talking about a minor beat here. Management is calling this a record-breaking performance for a reason. Okay, look at this. This is where it gets really impressive. The margins. I mean, their gross margin shot up by 500 basis points. For those of you keeping score at home, that's a full 5%. And their adjusted EBITDA margin up 330 basis points to a record 24.1%. This isn't just twinking the numbers, folks. This is a sign of some seriously powerful execution. They're making things more efficiently. They're selling smarter. This is the heart of the transformation story they've been telling. And you know, this wasn't some one-quarter wonder. The entire year was a blockbuster. This was their second record year in a row. Sales up almost 9%. Adjusted earnings per share, get this, up a whopping 37%. And they're just printing cash, generating a ton of free cash flow, and still handing back almost $57 million to shareholders. I mean, no matter how you slice it, that is just a phenomenal year. All right, so if the results were so stellar, then the problem can't be in the rearview mirror, right? It has to be what's on the road ahead. And that's exactly it. Let's talk about the guidance, because this is where the music stops and we figure out why investors got so spooked. And here it is. This is the smoking gun. After putting up 8.7% sales growth this past year, they're guiding for, wait for it, just 1.4 to 2.8% next year. Oof. For Wall Street, which is all about what have you done for me lately, that's like hitting a brick wall. Even though they said margins would still get better, that slowdown in revenue growth was the big, flashing red light that investors just couldn't look past. Now, to be fair, management didn't just pull this number out of thin air. They were pretty upfront about the headwinds they're seeing. They've baked in a pretty big drop in residential construction. They're bracing for a 3% hit to cost because of tariffs. And on top of that, this forecast doesn't even assume they'll raise prices. So yeah, it's a cautious number, but it's based on some very real-world challenges they're expecting to face. So what you have here is this classic Wall Street story, right? You've got two completely different narratives spinning out of the exact same set of facts. You have management story, and then you have the market story. And right now, they couldn't be further apart. You can just hear the pride in the CEO's voice. I mean, listen to this quote. Marty Zakis is basically saying, hey, look at what we just did. We closed the year on a high note, another record performance. Their whole message is about the incredible transformation they've pulled off over the last 2 years, pointing to that massive 600 basis point jump in gross margin. They're looking at a fundamentally stronger company. And this really lays it all out, the two competing tales. On one hand, you've got management. They're focused on the huge success of their multi-year turnaround, the record margins, and his big long-term tailwind from infrastructure spending. But then you've got the market. And what's the market scared of? That tiny revenue growth number, weakness in housing, and cost pressures from tariffs. So management sees a long-term winner, but the market is just seeing a cyclical stock staring down a slowdown. Two totally different perspectives. So, which story is the right one? How do you invest in a situation like this? Well, that brings us to the final part, the next call. We're going to cut through the noise and give you our take on what to expect and how we're rating the stock.
All right, here's our call. Let's break it down. 1. The next quarter, Q1, is probably going to be pretty sluggish. It's a seasonally weak period anyway, and that residential slowdown is going to keep the pressure on. The big test for management will be protecting those awesome margins they've built up. 2. Price action. We think the stock is probably going to be stuck in a range for a while. It's just going to tread water, likely underperforming the wider market, until one of two things happens. Either revenue growth starts to pick back up, or that big infrastructure spending story starts to feel more real. And that leads us to number 3, our official rating, market perform. Look, the turnaround they've executed is fantastic, truly, but that good news is already baked into the price, and that weak guidance for the top line, it just puts a lid on the stock's potential for now.
And of course, we have to say it. This is not financial advice. This analysis is for informational purposes only.